We're going to calculate the stock price for Biogen. First thing we need is the market cap, which is 49.3 billion. And now we need a stock price, 302.36. And this way we figured out the shares outstanding because it's just the market cap divided by the stock price, and that's 163 million shares outstanding. So what we're going to do in this video is we're going to estimate the future free cash flow of the company and then discount that number back to today's values. And then we have an intrinsic value for the company. And then we divide that number by the shares outstanding, and we'll have the intrinsic stock price. Then we can compare it to the actual stock price to see if it's a good buy or not a good buy. So the first thing we need to do now is get the free cash flows, and that's in Yahoo Finance in the cash flow section. So we'll just pull the past 4 years of free cash flows, and this is the cash that's left over after operating the business. Next, we need net income, which is on the income statement, and that's the profit and loss for a given year. And then we need the revenue, and that's also in the income statement. So we'll take a quick look at the numbers. As you can see, free cash flow, it drops from 2016 to 17, then jumps up a lot, then increases a little bit. And free cash flow can be a little lumpy because that's actual cash that goes in and out. So if there was a large purchase one year, it may drop a lot. Net income is a profit and loss for a given year. And that should be smoother than free cash flow because they use accrual accounting. So they only account for things that actually have happened that year, even if they purchased those items years ago. And revenue is just sales, and that tends to be the smoothest number from year to year. Now let's look at that capital structure so we can figure out what to discount the free cash flows by. So let's get the interest expense. This is the interest they pay on their debt. That's 187 million. Let's see how much debt they have. We got to go to the balance sheet for that, the liabilities section. And then the current debt is 1.5 billion. That's a debt that's due within 12 months. And the long-term debt is 2.8 billion. That's debt due beyond 12 months. And they pay 4.3% interest on the debt. Now, since interest is tax deductible, let's get their effective tax rate. We'll go back to the income statement. We'll get the income before tax. And then the income tax expense. So 16%. So the cost of the debt is only 3.6% because they get that deduction. And you can see 8% of the capital structure is debt, which is a pretty good number. You want lower the better, but that's a pretty good number. Now let's look at the cost of equity. We need the beta. So the beta is 0.51. That's a really low beta. That means it moves half of what the market moves. So to get the weighted average cost of capital, we just combine the cost of equity and the cost of debt. And that's what we use to discount the future cash flows by. That's also the number this company uses to make investment decisions. They use this rate for discounting purposes. So we estimated the future free cash flows 4 years out, and then we did a terminal value, which is all years past year 4. Then we discounted those numbers back to today, and the sum is $86 billion. And when we divide that by 163 million shares, we get an intrinsic stock price of $5.29. So this is considered a buy because it's trading at 302. So it's trading at a 43% discount. Let's look at the historical stock price. So it was never really much more than 400. So it's always been trading at a discount. So stocks can always trade higher or lower than intrinsic value. The stock price moves based off of demand of the market. So if more people are looking to buy a stock, the price gets bid up. And if more people are looking to sell a stock, the price gets pushed down. And As you know, everybody has their own opinion on the value of a stock. And this is my model. It's my opinion. So thanks for watching.